Welcome to Real Estate Hustlers Podcast. I am your host, Josh Appleman, founder and CEO of Appleman Properties. Today, we're joined with Jesse Dickens. Jesse is a Denver-based medical professional, has a thriving side career in real estate, owning 341 plus units nationwide. From starting with fix and flips, he is now set for major expansion in 2023 and beyond. Jesse, we're excited to have you on the show today. If you could, just let the audience know a little bit more about yourself.
Sure. Thanks for having me, Josh. Really appreciate it and glad to be here. Yeah, my backstory is kind of a long one, but so I'll give you the abbreviated version. I initially went to school and got a music business degree, finished up with that and said, okay, that was fun, but what the heck do you do with a music business degree? So took a year off, did a little bit of soul searching, knew I wanted to get into medicine from there. So I took the degree that I had and was able to transition into cardiac sonography or ultrasounds on the heart. So I've been doing that for about 7 years or so. Love what I do. Don't have any plans of not doing that anytime in the near future, but also realize the fallacies of just having a just W-2 profession as my only source of income. Read some books, listened to some podcasts, read some blogs that really highlighted that probably in 2016, 2017. And then in 2019, started jumping into real estate. Invested passively in a couple fix and flips just to understand the transaction-based nature of what real estate transactions were like, and then went out and did a flip on my own. Quickly realized that flipping was not necessarily the vehicle for me. It wasn't the skill set that I really fit, and I had many sleepless nights doing that. So jumped into long-term buy and hold processes based around multifamily. So that's been the primary focus of my real estate career. Have also done some stuff in the short-term rental space, and that's kind of where I'm sitting today. I mean, I live in Denver, but my portfolio is in Arizona, South Carolina, and I'm also re-engaging with some local markets here in Colorado as well.
Nice, good deal. So you've already you're into multifamily. You've purchased your first properties. What was the first property in multifamily? What was that like?
Sure, it was a 24 unit JV deal that I did with some friends and business partners that I made through a mentorship program that I went through. And we all really fell in love with the Tucson, Arizona market, started diving into that market right at the beginning of COVID. It was very challenging. There were some hurdles with that. But it took us almost a year to close our first deal. So we found this first deal, which is a 24 unit deal. Your typical value add, C-class property, C-class area, a lot of meat on the bone, and cut our teeth with that. We still own that property. We put long-term fixed rate debt on it. And that is that's our baby. It's our cash flow baby. We've since then purchased an 8 unit, a 28 unit, and then some of my partners from that group, we did kind of a spinoff and we co-GP'd a 281 unit deal in South Carolina.
Nice. That's very cool. On your value add property, what did you all do to increase the value of the property?
Sure. It was really kind of your standard value add where it was owner managed for over a decade. Rents were at least 30% below market, just as is. So we came in, there was some deferred maintenance, not too much. All the units needed to be updated, and the property as a whole just needed a little bit of freshening up aesthetically, more so than anything. A couple of CapEx items, but mainly aesthetically, it needed some love. So we went in, we took somewhat of an outside in approach. So we cleaned up the outside. We put professional management in place. Everyone was paying in an envelope with cash that the owner would walk around on the first or second of the month and literally get an envelope from them. It was that kind of mom and pop. That's like the ultimate mom and pop seller that we lick our lips when we come across one of those, and had a lot of pride in ownership, but he was very limited by constraints around capital and systems to really bring the property to life. So we really cleaned up the outside of the property, came in the first 3-4 months, just wanted to show the tenant base that we're going to put some time, attention, and money into areas of this property that have been neglected for several years. We didn't want to just come in and start jacking up the rents. So as we got to renewals, we kind of found a happy medium to say, hey, this is what market rent is. This is where you've been at. you've been a great paying tenant. We'd love to retain you. So we did these kind of halfway bumps, and we really didn't turn many units at all because it was still under market value. So we stayed our first year, even during COVID, during an eviction moratorium, we stayed at 98.5% economic occupancy.
Nice.
So the only time we had any vacancy was when someone actually did move out. We'd turn a unit, and in 30 days, we'd have someone else in there. And then year two, we really we saw that we probably weren't pushing as much as we should. And, we tried to, there's a human element to this too. And we didn't want to just come in and just kick people out, and young families. So we really wanted to show that we were going to put time, attention and energy and money into the property where it had been neglected. So year two, we really pushed a little bit harder, started turning more units, and just updating them up to current market standards. And we took rents from that property. Every rent on this 24 unit property was either $560 or $565. There was a $5 difference in the rents.
Was that like a 1 bedroom versus 2 bedroom?
No, they're all 1 bedrooms.
Okay.
They were just all uniform across the board. And today, our last 3 units that we renovated are getting 1025.
Yeah.
So it's incredible the amount of equity that we've created there, and the cash flow has been unbelievable because we bought on actuals back then. We have a lot of trapped equity in that property because we put on long-term fixed rate debt. So we love our interest rate. There's no floating component to it, but we do have some equity that's trapped in there.
Yeah.
But we look at real estate as a long-term win and building that equity long-term over time. So we're very happy with it.
Yeah, you could get a credit line and use that equity and go buy another one with that one property. Essentially creates another cash flowing property.
Sure, we've talked about getting some kind of supplemental on it.
Yeah, that's always a good play. If the dollars, I think, would make sense because you've got almost 100% markup on your rent from in place to where your performer was at. Yep. So there could be a really good play there. Awesome. What for the listeners, when you got it under contract, or I guess let's if you could go through the process of how you found it, put it under contract, due diligence, and then how you obtained financing.
Sure. It was direct to seller. We
Nice.
were really struggling as newer investors at the time, building relationships with brokers, and it was hard to get a call back. It was hard for anyone to take us seriously. They get calls on a weekly basis from these quote unquote new investors that are trying to break into a market. And understandably, especially back then, the market was so hot, they didn't want to put a lot of time or effort into building and nurturing that relationship. So we decided to take matters into our own hands and go direct to seller, cold calling, pulling lists off different data sites, direct mail campaigns. So we got a call back on a flyer that we sent out, and met a gentleman who said, "I will never do a deal with a broker again. I will only sell this off market." We said, "We're your guys." We've got some local boots on the ground there in Arizona. So he was able to really form that relationship with the seller, go out to lunch. It took probably 3 months of negotiating to come to a common ground on price. And as far as financing goes, because it was 100% occupied, and because of at that point in time during 2020, we had no idea what direction this whole thing was going. I work in medical, and I have a very different view on COVID as I did back then. And we weren't sure. So we wanted to take the safest route possible. So we said long-term fixed rate debt, non-recourse. It qualified for agency. We had to bring on a KP that had agency experience to allow us to actually acquire that loan. But we got 81% loan to value on the actuals. So it was perfect. It was, we weren't in for too much on it. It's extremely low risk loan. And the process of going through agency is a challenge. But it was absolutely worth it. So
what interest rate were y'all able to get?
3.75 at the time.
That's incredible. That's and it's long term. There are some agency loans that you can do a 40-year amortization and lock it. I mean, the agency is definitely the premium of the premium, and the process is horrible. But if you can go through it and weather it, it's well worth it.
Yep.
That's wild. And then how did you all come about the GP opportunity with the general partnership and the syndication, and then partaking on that deal?
So the next deal that we did was an 8-unit, so that was a smaller deal, also a JV. The next one, now that we had 2 deals under our belt, same market, had really built our team, systems, processes, we really wanted to put our own capital at risk before bringing on any investor capital, get that proof of concept. And then our 28 unit that we closed last year in February, we did that as a syndication and had built up. That was basically, we did a 506B. So it was all people that we had relationships with before. They knew what we were doing in real estate, and that trust factor was already built in. But that was, we just got to a point where we know that we're going to eventually run out of our own capital. And if we feel comfortable in taking on certain risks and putting our own capital up with it alongside of investor capital, that's where we finally got to a point where we were ready to bring on investor capital and start building that way.
Were you all looking for, you're I guess that the bigger deal is 280 some units, is that correct?
Yes.
So did you all find the deal, or were you asked to come on to the
No, we came on as a co-GP, so we essentially raised capital on that deal. So I had met just through the general real estate sphere that you and I both engulf ourselves in, had met an individual that lives in Greenville, South Carolina, and had connected with him, through social media. And then we connected in person at a conference here in Denver, and just hit it off and walked away from that conversation saying, hey, I don't know what any kind of partnership would look like, but I would love to do a deal with you. And it was mutual. There were mutual feelings of that. So we just started kind of, continuing the conversation and prepping our investors for that market. And when he landed a deal with an even bigger operator, a large scale operator that had the purchasing power to take down that size of the property, they teamed up and formed their GP team. And then we came on as a co-GP to that.
Nice. That's huge. And the bigger deals are, there's enough there to have a lot of people on a GP, or a lot of people involved, to where it's fun. It's the journey there, and professional people. So how are you all help managing that property? And then is it a value add property, or is it core?
Yeah, absolutely. Value add property, C class property in a B class area.
Nice. Probably
less than 10 minutes from downtown. So I wouldn't say it's a core asset, but it's absolutely, it's got the meat on the bone there. Well, quite a bit of loss to lease. We're not heavy in the operations of that. We are part of a quarterly management call, and can put in our 2 cents about it. And it's really a way for us to learn from a large scale professional syndicator. We're full-time employees that have been building a real estate business alongside of them. So for us to partner with full-time syndicators and to be able to get that level of professionalism and to feel confident in bringing capital to the table, our investors to the table alongside that's kind of what we needed to feel comfortable. So we saw that in the track record and just the way that they operate. You can tell pretty quickly from you spend some time with someone either on a call or just in correspondence with emails and texts and calls. You kind of quickly see how people operate, and we want to see beyond just business. What are your life skills like? We love doing business with people that have families. It's not a must for us, but we're all family oriented, and we do everything that we do for our families. So we want to align our interests and values with other operators. That's the absolute number one thing for them. So that's how we got involved with that, and it's been good so far.
Yeah, I think everyone's got their pet peeves, but when you're looking to go in a venture with somebody else, it's everything counts, all the way to communication. What is the timeline on getting back, on replying to emails, and inbound and outbound? It all goes, because it's what to expect. But when you're in a deal, if you're not in one yet, it's what does it look like up to this point? So it's important to just do what you say you're going to do and be who you say you are at all times. I think we've all got some stories, but absolutely. How are you all underwriting your deals now? Are you currently buying? Are you looking for deals, or?
So I'm working with a new team here in Colorado with Denver-based investors, actually a couple individuals that I've known for probably about 10 to 12 years, just in other facets of my life before any of us got into investing. And now we've kind of circled back up, and we have there's a unique blend of skill sets and previous experience that really, it kind of came together very serendipitously. And it's really cool to see how that has come together. And we're starting to look at some assets here, Denver, Colorado Springs, possibly Northern Colorado. So we've got some offers out on the table right now. We're absolutely in a buy mode. We're seeing a discount in the market. It's very challenging with financing. We're looking at some very low leverage deals. And if we can make it make sense right now with those kind of numbers, we feel like it's actually one of the safest times to buy, because if you can make it work with super low leverage and fixed rate debt and just plan on a refi, and we're also looking at a longer term horizon. We're looking, and we've got an investor base that's open to not the 3 to 5 year window, but the 5 to 10 plus year window. Yeah. So we're looking to refi our capital out between years 4 and 5, and then maybe put 5 to 10 year fixed rate debt on it again from there, and hold this thing in perpetuity as long as we can get an asset that it's the right vintage, the right location. And it's something our buy box has gotten smaller, but we're more aggressive with that buy box.
What is the unit size that you all are going after? Is it just anything within workforce C value add?
We really want to be more in the B class.
Yeah.
That's what we're focusing on now. Like the deal that we did last year, where it was a C class asset in a B class neighborhood. We're open to that. If there is a path to create a value add to really kind of bring it up to a C plus at least, or a B minus, then we're totally open to that. But really, we're super focused on certain zip codes that have an average median household income over a certain threshold. We want B class tenants for the long term, and we're basically, we want to be anything 20 units and up. We have some larger scale equity partners. If we were to get into the 50 to 100 units that could come in and backfill us, that are open for that long-term hold period. But we really like the sweet spot, 20 to 50 units, where the institutional is not even taking a look at it. And then the smaller mom and pop investors that are doing duplexes and fourplexes are probably not ready to step into that game, and are probably more grasped by the fear that's in the market right now. We love it. We love the fear that's going on. So there's not been a lot of transactions, but I think the ones that are going on, I think they're going to be great long-term investments.
What's been your experience with property management so far? I know you said you're using third party. So what?
It's a challenge. That is probably the biggest challenge that we faced in Tucson. We are on our 4th property manager in 3 years. This last one, we really thought we found the PM company that would be with us long term, that we would partner with, bring in on the equity side of deals. And unfortunately, they're just leaving the Tucson market altogether. So they left our 2 properties with them, 100% occupied, and in unbelievable shape. It took us 3 property managers to get there, and so we're in a transition right now, going to another property manager, and it's just you just hold your breath, because you're always going to get the beautiful presentation, and they're gonna show you how all of their properties are 95 to 100% occupied, and they're pushing rents, and they're keeping expenses down. And then you get in, and sometimes you see that a lot of it's a smoke show. So it really creates, the asset management piece is just so vital, because you really do have to manage the manager until they can prove to you and earn that trust. And we don't want to micromanage, but we have to be on top of every single unit turn, every single expense, every single piece of delinquency, because no one's going to care for your property like you would. So that's why we love the idea of bringing the property manager, if they have kind of an entrepreneurial mindset, to bring them onto the GP and give them a piece of the equity, have them bring down their PM costs, and then they really do treat it like it's theirs because it is.
Yeah.
So I don't know. What have you seen? Do you use third party?
Oh yeah, no, that's exactly it. That's spot on. We did use third party, and got to a point where we went through so many different property management companies on one property that we had to make a decision whether to bring it in house or try another company, and there was no one else to even try in that location. So we we cut the cord and had to take them all under roof, under our own management. And I mean, even up to that point, we were managing the property managers and their company, but you can tell when there's smoke, there's fire, because you can tell your properties are suffering. The expenses are going up because they're essentially throwing money at issues that come up. Your expenses go up for them to try to offset their pain by just throwing money at problems. And with us having control, vertically integrated, the renovations, the property management, asset management, ownership, it's our costs are where they should be, much cheaper, and we're able to poke as hard as we need to poke to get things done. We're in full control. So the market's tough right now for employment. It's finding the right people. It's extremely tough.
Yeah.
So,
how many units did you have when you brought it in house?
We were tipping 100, so it was a tough. We were not quite there to where it made sense at all, but it got to a point where we had to make it make sense, just because it was we couldn't piece it off and just manage that one property and for it to be financially economic. It just wouldn't. It makes sense right now because of where we're at and what all we do, but I would have rather been at like 500 units because it just, it's economies of scale, but it gets to a point where, and now the properties are performing much better, more financially healthy. And you're not essentially seeing 7 to 10% out the door every month, if not more. You get feed to death, and don't get me wrong, there's great property management companies out there. For us, it wasn't working. So we had to make a decision. I think also you get to a certain unit count on a property and the companies become a different caliber as well. So it's when you're in kind of a scattered site properties, it becomes tougher to get the different property management companies to work out.
100%. Yeah.
But
that's probably the biggest challenge with that. That's probably also why there's less competition in this unit count space, because that is the challenge. If anyone has operated in that space, chances are you've dealt with these same kind of issues that you and I are talking about. So yeah,
100%. So where's what's the horizon look like? How far are you going to take this?
So that's a good question. It's it'll be really interesting to see how this Colorado team evolves and what that turns into, and the level that we're able to grow and scale. I've never owned a property that I've been able to just drive an hour to and put my hands on it and be there. All of my investments have been out of state, which has been great in a sense that it's forced me to rely on systems and processes. But I think the ability to grow and scale and just be even more in tune to what's going on in your own market is just going to help us grow faster. So there's a lot that's up in the air. Also looking at stuff still in Tucson, still open to co-GP opportunities. We have a database that is looking for deals, and we need to find deals that make sense for them, but we're not going to jump into anything just to do a deal. So we're always looking to grow in partnerships and new relationships that can be mutually beneficial. So we'll see. Then as far as still working W-2, who knows? Who knows what as of right now, it is manageable. I have a lot of flexibility with my job, and we'll see what gives. But like I said, I enjoy what I do, so I don't necessarily want to just stop. I'm not in a profession where all I want to do is get out of my job. The idea of time freedom for me is just as important as financial freedom. The ability for me to say, hey, I want to work for this specific cardiologist maybe once a week, and just to keep my skill set, to be with my patients, and do that because I love it, not because my mortgage payment depends on it. So probably over the 2 to 3 year horizon, that's where I see that kind of taking place, maybe a little bit quicker than that, depending on how quick we can scale. But that's what my projections are right now. And sometimes you make projections and you just have to laugh at them a couple of years later because things never pan out the way that you think that they will.
Yeah, I think there's a quote: people overestimate what they can get done in a year and underestimate what they can get done in 5 years. So it's
so true.
Yeah, and it truly is. It's especially when you get the right people in the right room, and things can transpire to something huge for sure. Real quick, what would be a couple books that you would recommend somebody to read to if they wanted to get into real estate?
Sure. I mean, I think it kind of depends on the level of where they're at. If this is a question that you ask a lot of guests, then you're probably going to get the same answer of I'm going to throw Rich Dad Poor Dad out there because it is just so vital. That is the one book that completely changed my life.
Yeah.
I read that book in 2016, right after I just purchased our first single family home. And I just graduated after being in school for several years to do what I'm doing currently, and just realize all those fallacies, they all came together. And it's not going to teach you how to buy real estate, but it's going to give you the perspective that you need to understand that real estate, business, or any type of investment portfolio is absolutely key in creating that life of freedom. Another one that I would recommend that, again, is also probably not real estate specific, but I'd say The Go Giver by Bob Burg, because to me, it's absolutely a mindset kind of book. And to me, the logistics of what we do, underwriting deals, building broker relationships, understanding how to learn a P&L, all those logistics maybe make up 10 to 20% of actual success in our industry. I think the vast majority of it comes from being able to overcome the mental hurdles that pop up on a daily basis. We all deal with imposter syndrome. We all deal with not knowing if this is our true calling, especially in the beginning. It took me a year before I closed my first deal. And that entire time I was questioning that I just make a huge mistake with this. And being able to not have those thoughts, because those I think are really natural, but to be able to consistently push through that is what's really created just a mindset of I'm going to win. It's just a matter of when. And that's not an arrogant thing. That's just a 100% confidence and belief in that this is the right thing for me to be doing. And The Go Giver is about, I don't want to ruin the book, but I would just say go read the book.
That's it. I like that. Go read the book and then figure it out.
And then we'll chat about it afterwards.
Yeah. That's phenomenal. Awesome, Jesse. If somebody wants to learn more about yourself, what you do, and how they can possibly add value to what you are doing, how can they get a hold of you?
Sure. Well, our website is wealthcarecap.com. My email is jesse@wealthcarecap.com. And I'll even throw my phone number out there. Yeah. That's the easiest way to get a hold of me. 720-229-9899. If anyone wants to connect, feel free to reach out. I love chatting real estate and everything else.
Awesome, Jesse. We definitely appreciate your time. I look forward to following you and talking soon.
Yeah, thanks, Josh. Appreciate it.
All right.